Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back our good friend, Cox Automotive Senior Economist, Charlie Chesbrough. Charlie, I imagine you have a lot to cover today, so I'll let you do the talking now. Take it away.
All right. Well, thank you, Rachel, and thank you to everybody for joining us today. We're going to give you the automotive market outlook and what we're seeing here in November of 2020. And I got to say, if I had to sum it all up, it's looking like a pretty dark winter for the next couple months. But I think when we get to next spring, next summer, there's a reason to be very optimistic that the conditions are in the framework to have a very, very strong year next year, certainly at least in the second half. But we got to get through this virus, and that's really kind of the big hiccup that we've got right now. I'm going to take you quickly through what we're seeing with the virus and kind of give you an update on what we're seeing in the U.S. economy, talk a bit about what we're seeing from consumers and dealers in terms of what their opinion is as to where we're at right now, and then I'll take you through some of our usual slides talking about the status of the new and used market. And I want to illustrate for you a couple spots where I think we may be seeing a new normal emerging, or certainly some interesting trends from the data post-pandemic. But let's talk about the virus first. And what we can see here, this is on the left, we're looking at the 7-day moving average of daily cases. As I'm sure you're well aware, if you've been paying attention to the news, it's really been exploding the last couple of weeks. I think we had close to 150,000 cases yesterday. We're now approaching 2,000 deaths each day. The danger here is that as these caseloads really explode, and we could be up to 200,000 cases a day very, very soon, it's going to overwhelm the hospitals. And all of the very good health outcomes that we've been having so far in recent months regarding the virus aren't because the virus is less deadly. It's still just as deadly. It's just that hospitals have been able to treat it well. We've got better therapeutics to treat the illness, as well as they haven't been overrun, so they can give every patient the time that he or she needs. But now the concern is, and particularly in many in the middle part of the country states, that the hospitals are getting overwhelmed and they can't give each patient all of the care that they need. So that's when the death rate starts to go up. And I was just watching an analyst on TV a few moments ago, and they're saying that we're looking at potentially 400,000 deaths in total, so another 150,000 from what we have now by Inauguration Day or by late January. So this virus is really kicking in, and as a result of that, we may start to see shutdowns occur again in parts around the country. And what we can see here on the right, this is where the pandemic level in red, the cases are really, really high. It would not be surprising if we don't start to see governors having to take some action around the country. Certainly none of this is going to be good news for automotive sales. I would suggest to most dealers to, if you put away any of your digital retailing capability, or if you thought you could put away the hand sanitizer in the lobby, I would suggest to you it's time to get all that back out and get ready for the second wave, because I think certainly for the remainder of November and December and into January, the case rates are going to be very, very high regarding this virus. But in terms of the economy, the news is a little bit better, and we're really starting to see some incredible economic growth numbers that came out in the third quarter. This is looking at gross domestic product, percentage growth over quarter, and you can see in the middle of this chart is the Great Recession. It almost looks quaint in terms of its decline at this point relative to what we've just gone through with COVID-19. We can see that during the COVID period, we had a 5% decline in the economy in the first quarter. It jumped to 31% in the second quarter, but it bounced back by 33% here in Q3. The question is where are we going in Q4? I mean, that's clearly what everyone wants to know. And I think it's the big question mark out there. There's a lot of concern that that the stimulus that was appeared to be quite successful in terms of rejuvenating this economy and getting things back on the right track. Well, all of that was well over 6 months ago now. And so there's a lot of concern that's a little long in the tooth. It's not going to have quite the impact on supporting the economy. And there's a lot of talk that in the service sector, particularly in the restaurant industry, they're being decimated. And if they have to close down again this winter, as everyone moves indoors and much of the outdoor eating that we were doing here in the north has to end because people can't eat outside in the snow, that the restaurant sector is really going to get hit hard, and many, many restaurants are going to go under here in the fourth quarter and the first quarter, particularly if we have to shut down because of COVID. So there's still a lot that we're dealing with out there. But the view is, and I just heard a presentation on this from an economist, that when we get into the second half of next year, there's going to be tremendous potential to have incredible economic growth in this economy. The virus cure should be spread out at that point, that we should be seeing a lot of vaccination around the country, so the virus should be in a much better situation. And there's going to be probably a second round of stimulus that's going to be coming sometime in February, which, in addition to a lot of the stimulus that we've already have that many folks have just been sitting on, they haven't been spending because they haven't been traveling, they haven't been going out to eat. There's the real opportunity that this economy could unleash a whole bunch of potential growth in the second half of next year. And so that's starting to get a little bit momentum and thinking out there that may be the direction we're going. But until we get to then, it's going to be a little bit of rough going. When we look at the employment situation out there at the left, we're looking at continuing claims. These are folks that have lost their job and are collecting unemployment claims. On the right, these are folks who got bailout money and who's still receiving some of that bailout money. And you can see in some of those early COVID hit states, those folks are still struggling. So in general, the situation out there regarding employment has improved dramatically. The unemployment rate has fallen to 6.9%, substantially down from the 20% that we were approaching just a few months ago. So the situation out there has improved, but it still remains very delicate because we do still have a lot of people out there that remain unemployed. I think one of the important things to note, though, that in automotive, it does not appear that our normal customer base has been hit as hard by this virus as some other sectors may have been hit. And I think it's because we don't have a lot of hourly workers that are out there buying new vehicles and probably not buying the expensive gently used vehicles either. It's too high a price tag for those income level of workers. So we've been insulated a little bit from what's happened so far, and hopefully that's going to continue into 2021. In terms of where we're at in the recovery, well, at this point, we're looking that we're still down about 20%. We're about 80% economy is kind of the situation we're in. This is Moody's index in terms of measuring overall economic activity. And so we remain quite suppressed. And you can see that some states in particular, with Illinois and New York and New Mexico, remaining in quite recessionary environment, or well below their pre-recession levels of economic activity. Other states like Maine and Idaho, they're down just a little bit. They seem to be in a better situation, but of course they're relatively small economic output states. So that doesn't really help the whole country as a whole. But this is one of the things we're seeing, that the economy has fallen. It's made a nice recovery, but we're kind of stagnating at down 20%. It's bouncing around a little bit, but it's not like we're seeing any kind of V-shaped recovery across the board in the economy. And what we do have here at Cox Automotive, we've got access to a new data set that's kind of interesting, and I'm showing you some of that data here. It's from Equifax and Verisk, and it looks at credit card spending activity. So we can now look at consumer spending on their credit card on a year-over-year basis. So we can look at different sectors of the economy. And what I have here on the left is looking at the year-over-year change in consumer spending by week. And the gray number is sort of the overall economy. So you can see it fell and it made a comeback. But different parts of that economy, as it relates to the automotive sector, are really at very different stages of recovery. And you can see in blue, that's just spending on vehicles in general. It now is in positive territory. But at the other end, you can see in the green line, gas station spending still remains down about 20% from where it was the same week last year. Not surprising. People are working from home. They're not commuting. They're not doing vacations. So spending on gasoline is down. And you can see ride hailing in the purple there. People aren't doing Uber and Lyft as much. One, they're not having to travel as much and go downtown and go to work. But also they may be a little reluctant to do any kind of ride-sharing activity in the middle of this pandemic. So we're really seeing that there's different aspects of automotive that are at different stages of their recovery. And on the right, we can see overall in the U.S. economy, where are consumers spending money in this pandemic? And what's interesting at the top of this is you can see that spending on sporting goods and toy stores, the spending is up substantially from where it was at this point last year. as well as in big appliances and big couches and furniture. People have been spending quite a bit of money on that. And then at the other end of the spectrum, you can see in the bottom in red, airline spending, spending on travel, hotels, that type of thing. Not surprising, these service focused industries, they're down substantially, and it's likely to continue to be so, certainly till we get the vaccine out there for everybody to start using. So what do we see there in terms of public opinion and what they're thinking? Well, we're seeing a similar story when we look at overall consumer sentiment. And this is Morning Consult's survey of consumers. They talk to thousands of people every day to gauge what their measure is in terms of the overall economic situation. And you can see that looking back in mid-March, this index fell dramatically to 81. It's now made a little bit of a recovery, but to a little bit above 90, but it's still down, just like the broader economy, down about 20%. Consumer sentiment still remains down about 20%. But what's really interesting here, and I want you all to focus on this, is if you look at that 90.3, we've seen a little bit of a decline. That's sort of the first days of reaction to the election. So no earth-shattering changes in the overall level of consumer sentiment, but it has started to tick down a little bit. Now, we've been talking about consumer sentiment, and I showed you all this slide, I think, the last time we met, and I don't want to rehash it all over again, but I just wanted to show you what's represented. So on the previous slide, when I was showing you consumer sentiment, well, that little nugget there is all highlighted in that blue dotted circle I have there in the upper right, under where Biden was elected. That's the green line right there. That's what I showed you on that previous slide. That's overall consumer sentiment. But we know within that we have Republicans and we have Democrats. And Republicans under a Trump administration are much more optimistic than Democrats are under a Trump administration. And so what I'm showing you on this slide, as I've shown you before, this is consumer sentiment, but it's then split out by party affiliation. And when a Democrat is in office, Democrats are much more optimistic. When a Republican comes to office, Republicans are much more optimistic. Now we're going to have a Democrat in office again. We should see Democrats much more optimistic. What's particularly interesting this time is this purple line, because the gap between the level of optimism between Republicans and Democrats has never been so large. Republicans are ecstatic under a Trump presidency. Democrats are miserable under a Trump presidency. Well, now all of a sudden we're going to see a massive change as to who thinks things are great out there and who thinks things are terrible out there. And that may mean that who's coming in to buy vehicles may be different, because folks that certain products may cater to certain types of buyers. Pickup trucks in Texas, those buyers may now be in the dumps. If it ends up that President Biden does win, they may be a little bit more pessimistic, not wanting to go out and buy a truck. However, blue state electric vehicles or alternative vehicles, they may be under greater demand because those natural buyers are now a little bit more interested, a little bit more optimistic. And in fact, we have some early data that actually suggests that this very thing is happening right now. And I apologize for the numbers or the lines being a little bit difficult to see. But on the left here, this is looking at Morning Consult data. They can identify who's in the market to be buying a vehicle, who are purchase intenders, and it identifies what is their party affiliation, or do they support President Trump, or do they not support President Trump. And you can see that in this blue line here on the left, in the last couple months, those respondents that are in the market to buy a vehicle and support President Trump, their likelihood to be buying has been ticking down the last few months. And that coincides with sort of this rise of the likelihood of a President Biden taking over. And you can see the yellow line, those who disapprove of President Trump, is starting to rise, meaning their intention to buy is actually rising. And when we look on the right, they actually look at Tesla vehicle buyers and who's intending to buy a Tesla. And you can see in just the last few days, a big decline in that blue line. Those are people who support President Trump, a big decline in their likelihood to purchase a Tesla in just the last few days. So I just point this out so that you keep in mind that over the next few weeks, the folks who are coming in and buying vehicles may be a substantially different type of customer than you've been seeing the last few years, because we've had this substantial change as a result of this election. And who sees things as good and bad out there, perceptions are going to change. So what do we see from dealers out there? Well, we have the latest index out here from the Dealer Sentiment Index. Cox Automotive surveys dealers, franchise and independent dealers around the country. we asked them a battery of questions to gauge their view on what they're seeing out there in the market. And this question we asked them is, how would you describe the current market for vehicles in the areas where you operate? And you can see in Q3 of 2020, we hit a record high for this number and this measure. We've only been doing it for about 3 years now, but you can see that the second quarter for dealers out there was a fantastic quarter in terms of sales and profitability. We just saw Wall Street announcements this last week from Ford, GM, FCA. Everybody was making billions of dollars, and I'm sure that we're going to find that the dealers out there got their own piece of the pie as well. So the situation out there with that stimulus money flushing everybody's pockets, the shock of this virus sort of passed initially. We saw a lot of sales activity over the summer for used vehicles, and really that created a tremendous amount of optimism for dealers out there. But we also asked them, well, is that optimism going to hang on? What do you expect in your market 3 months from now? And what you can see here on the far left in terms of what dealers were saying is that they're cautiously optimistic. They expect the market to be a little bit better, but nothing gangbusters. I would say, folks are hoping for the best, but planning for the worst maybe. And that's probably a good position to be in. We should have our Q4 numbers here fairly soon. I think we're going out into the field to be collecting data. But our expectation is that it is going to get a little bit more challenging out there, at least in terms of the profitability. But some of the situation out there is improving. And so that may mean that, sales could remain and should remain quite robust for the rest of this year. Now, one of the things that when we were doing this survey is we asked folks what was holding back their business. And the dealers told us in the third quarter, 60% of them cited limited inventory. And that had significantly increased substantially from the previous quarter. The impact of the virus itself and market conditions and the economy, all of these things were important, but becoming a little bit less important. And clearly this inventory issue was on the foremost of people's minds. And you can see there as well as number 5, the political climate, made a significant jump as well. And as I showed you on just the early slides, it is going to have an impact on the customer base and who's out there shopping. But I am happy to report that I think the inventory problem is getting better. That's not to say that it's solved yet. That's not to say that it's over. But we're definitely sort of through the worst of that crisis, so that should not be quite the headwind it may have been so far for the industry. And I'll take you through that right now in terms of what we're seeing. So let's talk about the new and used vehicle markets and the latest data we're seeing on them. And what I'm showing here on the left, this is rolling 30-day sales for the used and the new market. And you can see a nice V-shaped recovery in both of these markets. But the recovery is starting to change a little bit for these two markets. And what I have here on the left is the year-over-year change in those sales. And again, you can see a really nice V-shaped recovery, but that the used market really exploded out of this shutdown of this pandemic. And we saw, June and July, very, very strong used vehicle market up on a year-over-year basis. And again, I think we can attribute much of that to the stimulus that was given out to folks. And folks were kind of flush with cash before they kind of realized the pain or the suffering or the economic calamity that may be coming. The money came first. But on the other side, we can see in the new market, it didn't recover quite as quickly as used, but it's starting to gain a little bit momentum, and it's still starting to improve at the same time while the used market is now starting to decline. And I think what we're seeing here in terms of the annual change numbers, is this inventory situation having an impact on vehicle sales. That the new vehicle market was a little bit suppressed in the early days of recovery because the factories just weren't operating, just didn't have the ability to restock all the shelves for the dealers out there, and inventories got made fairly thin, as well as the delay in getting that new model year 2021 product out there, and folks not wanting to buy the old model year but waiting for the new year. And then on the used side, the fact that where there was so much economic or sales activity in June and July, they pulled down available inventories before the used vehicles could kind of restock themselves, and it made for a very tight inventory situation. This is all changing, though, and it's changed substantially. But let's start by talking about the new vehicle market and where we're at with that so far. This is looking at the monthly light vehicle sales SAAR on the left, The sales pace hit 16.4 million in September, and we had a very consistent recovery of 6 straight months of growth after having the decline that we had in April, the bottom. But then in October, we actually took our first down tick, just a hair. It was 16.2 million, so just down a little bit from 16.4. But it does suggest that maybe the market is starting to stagnate a little bit. We're not sort of in the same level of everything just recovering in one direction. What's happening underneath? Well, we know that the light truck market has really been holding up quite well. On a year-to-date basis, the whole market is down about 17%, but light trucks are only down just a little bit under 12%. What's really dragging on the market is car activity. It's down about 30% on total for the year. Much of that is by design. We know that Ford Fusion's gone out of production, and Chevy Cruze, and a lot of the domestic manufacturers have abandoned a lot of these small car segments. So the volume is just going to decline in general. But we're also seeing, I think, a change in who's out there buying vehicles. And I think a lot of the car segment buyers have left the new vehicle market. And they're either buying, or they're buying different products. Maybe they've ultimately just abandoned the car and they're getting a new crossover. Or it may be that they're taking their money and they're going, that they would normally buy a relatively inexpensive new car, and they've gone to the used market where there's so much more to choose from, and they can get that crossover that they may really want that's just got a few miles on it, but then it would be in their price range. Our expectation is for the market that we're going to finish this year at around 14.3 million. That's down about 16%. So we're expecting the fourth quarter here to kind of hum along here at the low 16 million range. That would take us into this, this low 14 million for the year. Not bad from where we thought we were going to end up just a few months ago in the depths of these prices. Our expectation next year is that the market is going to continue to recover, but only to about 15.2 million. And I would suggest to you right now, we're probably a little bit on the low side. We're staying on the conservative side till we get this smooth transition of government, until Congress can come to an agreement on a second stimulus, sometime next February. Until we get those two hurdles crossed, it does not seem to be a lot of reasons to be very optimistic about an even more aggressive next year. But it's certainly within the realm of possibility that we could see even stronger sales next year if this economy comes back a little bit stronger and we don't have any hiccups with our presidential transition. Now, one of the things that's really been contributing to the market has been this move to 0% financing. This is a chart that's showing the share of the loans out there from our own data that contracted at a 0% interest rate. And you can see that late March, early April, the industry went aggressive into these 0% financing offers. A lot of 0 for 72, some 0 for 84. Consumers really gobbled it up. We saw a huge surge in that. But as you can see, we're now starting to see a bit of a backing off of that. The industry is finding a little bit less need to be so aggressive with their financing offers. And so it does suggest that there's maybe a little bit less gas in the tank to really motivate vehicle sales this year. They've already gone to the 0% financing. They've kind of they've shot that arrow, if you will. They may try to do it again, but it seems to me that they've probably, in terms of that as a tool, it's probably had the most impact it's going to have. That's not to say it can't still support sales. But I think one of the things that we're seeing out there, and this may be a new normal for the market, is that we've seen a substantial shift in the average interest rate that folks are paying out there in the vehicle market. Now, this is a chart that's showing by month the share of the market of people who are buying retail vehicles, took out a loan, what share of the market is paying a 2% or less interest rate, what share of the market is paying a 2 to a 4% interest rate, a 4 to a 6 interest rate, a 6 to a 10, and then 10 and above on the interest rate. And what we can see that come March, I've highlighted that with that green arrow, we saw a huge move in the share of the market that was paying a less than a 2% interest rate. It went from about 13% of the market to over 30% of the market in the month of April. Really a huge jump. And it remained elevated through the summer, and now it's starting to back off. And the question is that, what happened? How did we get all of these new customers? And I think what's happening is we probably saw some people shift up a little bit from the 2 to 4%. Maybe they put a little bit more money down so they could qualify for the better interest rate. But I think what's probably more likely is that the folks who can qualify for these low interest rates have fallen out of the marketplace. And so the share of the market that's paying greater than a 4% interest rate has changed dramatically. 0 to 4% has risen almost 16% in terms of market share, the share of the market that's paying less than a 4% interest rate. And it's taken it directly from those in the middle, and then certainly more of your subprime type borrowers, those paying a 10% plus interest rate. So I think this is something we're going to see, that the remaining FICO scores out there, we're just not going to see as many folks that can afford to buy new vehicles that have these lower FICO scores. I think that may be one of the new normals that we're going to see out there. The other thing we're seeing is that average listing price continues to rise. Our latest data shows it's approaching $39,500 is the average price of a vehicle that's listed out there, quickly approaching $40,000. We may even get there before the end of the year. It's really just quite amazing how fast these vehicle prices are rising. Part of it, of course, is the technology of these vehicles and the components. People love the bells and whistles, and all of that is adding to the vehicle costs. Part of it as well is the fact that, as I showed you before, the car share continues to decline, so the product mix itself is a little bit more expensive, with the crossover being more expensive than its car cousin. So that's adding some to the price. But there's no doubt about it that we are seeing that the price of new vehicles continues to rise. It's growing, as you can see on the left here in the light blue, clearly an upward trend on price, somewhere in the neighborhood of 4 to 5% on an annualized basis. That's going to be faster than most real wages out there. So I think this trend of new vehicles growing faster than household incomes is probably going to continue. And I think it's just going to mean that this affordability issue is something the industry is going to be dealing with, indefinitely. The other thing we're looking at is the available supply. As I told you earlier, the supply situation is starting to improve, but it's definitely not back to where we were. And on the left, we're looking at total available supply. You can see that we've really bottomed out in this metric during July and August when supplies were particularly tight. It is now starting to improve. We know that the factories are really getting back up to speed and getting that inventory out there. And so that's allowing a little bit of a reprieve on the supply crunch, but it still remains tight out there. And if you look at the days supply here on the right, this is looking at days of supply. You can see that during the depths of this pandemic, when all of the dealerships around the country had to shut down, we saw a huge spike in the days of supply as sales essentially stopped around the country. But then it fell dramatically, and as you can see, it really kind of bottomed around late August, where it got really tight in terms of days supply, but now it's starting to tick up again. But the question is this the new normal? Will the industry want to maintain sort of this new tighter inventory situation? It's down about 25% from last year's levels. A lot of folks have been talking that maybe this is a new normal, that this idea of dealerships maintaining a plethora of products and trim variations, colors, maybe they need to streamline a little bit, carry a little bit less inventory. Certainly this idea of going in on a Saturday and going home with a vehicle is a very American way to buy a vehicle. The rest of the world doesn't really do it that way. You order your vehicle and it comes in weeks or months later. This is something the industry has been wanting to do for a long time. They like having things lean and mean. It allows them to stay off of being too aggressive on incentives. It certainly reduced costs for the dealerships out there. You guys don't have as much floor plan exposure. So this may be one of the emerging new normals that we see out of this pandemic, is a tighter inventory situation. The other thing we're seeing out there is that the model year rollover appears to be catching up and is almost back to last year's levels. I've been showing you this slide for a couple weeks, and now we can see that in blue there, in dark blue is the share of inventory that is model year 2021. The dotted blue line there is the share of inventory last year that was model year 2020. So you can see that it's following a very, very similar trajectory now. It's really caught up quite a bit. It's down just a little bit from the levels we were at last year. And then the sell down of the old inventory, the model year 2019 versus the model year 2018, it's down below 1%. So really not a major issue out there. So this is really something that I think has changed dramatically in recent weeks, that the industry has really caught up. And I think that does suggest that there, at least in terms of the inventory situation, that Q4 should not be anywhere near the crunch it was back in Q3. In terms of the inventory situation across different brands, You can see it's quite varied across the board. Lexus, Land Rover, Toyota, BMW appear to be in the very tightest inventory situation. Some of that's by design. Some manufacturers and brands like Toyota like to maintain a relatively tight inventory situation. But I think what's interesting is some of the luxury names you see on there. Land Rover, BMW, Mercedes. One would think in the depths of a pandemic, in a major recession, that some of these luxury brands may have a tough time selling vehicles. Well, the day's supply is suggesting that just not appear to be the case. And if you look at the other end of the spectrum on the far right, you can see some names like Cadillac, Lincoln, Buick, and then Genesis. Well, these are all sort of step cousins, to a BMW, to a Mercedes. Domestic luxury, as well as the Koreans' entrance into luxury. These seem to be doing that quite as well. The buyers of these vehicles do not seem to be quite as interested, and we're seeing that the base of supply is really quite elevated for these particular brands. So I think it's really kind of interesting that imported luxury versus domestic luxury are in a very substantially different situation. When we look at some of the different segments, it is kind of interesting when you look on the far left, the segments that pop out as being in a relatively tight inventory situation, suggesting fairly robust demand out there in the marketplace. You can see mid-size pickup, full-size pickup, luxury SUV crossovers. Those appear to be doing quite well out there in the marketplace. At the other end of the spectrum, it's kind of interesting. You see a lot of car names, just like I was telling you before. Car sales, we know car sales are down substantially, but it's also their days of supply is relatively high. And in particular, subcompacts, subcompact car, subcompact SUV, these are the least expensive products in the marketplace. We would expect them to be doing quite well in the middle of a pandemic and a recession. And yet we can see that their vehicle sales are not doing quite well. And to me, that does suggest that these buyers have left the new vehicle market, either because they can no longer afford to buy a vehicle, or as I said before, they may have moved over to the used market where maybe there's more to choose from, for that $20,000 to $30,000 if they want to spend. And lastly, I think it's interesting to look at the inventory situation by price category. And what I have here on the left, showing the days of supply by vehicles that are priced under $20,000 and then $20,000 to $30,000 on up above $80,000. And what you can see is that the least expensive products in the market have the most abundant supply. And again, that seems kind of counterintuitive. You would think that if it's inexpensive, that would be the first to go in the middle of a recession. But again, it's suggesting that there's just not a lot of, the interest in new vehicles at low price points just does not seem to be out there in the marketplace. The natural buyer for those products is not in the new vehicle market, or at least not to the levels that they are for other product segments. And what's also interesting, as you can see, in terms of inventory share, where is the industry focused, the latest and greatest new products? Well, for the lowest priced products, they also have the lowest new inventory share. Only a little over 15% of the less than $20,000 price point inventory out there is of the next model year. Other product segments or price segments have a much greater share of brand new products. So again, if you have a buyer that's out there that may be potentially interested, the industry is going to be showing them, model year 2020 vehicles. They haven't even put out there new vehicles. So I think we're really starting to see a new normal, which is a lot less interest in the new vehicle market for these $30,000 and below price points. And of course, we know this is a trend that's been going on for quite some time. I think what we're going to see post-COVID is that this is a trend that maybe is going to accelerate. And then let's just talk briefly about the used vehicle market. On the left here, I'm showing the available supply within the used vehicle market. And you can see it, too, went through a very significant supply crunch. Available supply really fell dramatically in mid-July, but it's now starting to make a little bit of a comeback. We know that there was more trade-in activity in the new vehicle market as it started to have a resurgence once the factories got up and running again. And we know that off-lease activity, some of which was delayed during the depths of the pandemic, a lot of financial institutions and OEMs asked folks to just hang on to their vehicle a little bit longer. But that started to come in as well. So we did see that supply in the used market has bounced off of the bottom, but it still remains a little bit challenged, not down quite as much as what we're seeing in the new market, but it still remains a little bit below the levels we were at last year, as we can see on day supply. But clearly, the day supply level has improved, or at least gotten a little bit tighter, or excuse me, a little bit looser in terms of available inventory. The day supply has risen a little bit, and that's because we're seeing a little bit of a back off on sales, and we're seeing a little bit of an increase on available supply, and the two together mean that they have more inventory available to sell to folks. The other interesting thing we're seeing out there, though, is the average list price is really taking off in the used vehicle market. What I'm showing you here on the left, this is average list price of vehicles out there, and you can see we reached a low of around $18,750 during the depths of the pandemic. It's now risen almost $3,000, the average price from the depths of the pandemic. Really just phenomenal price growth in the used vehicle market. The question we have to ask, is this all a temporary thing, or is this emerging as a new normal? We're looking at year-over-year prices now in the used vehicle market, 9-10% the last few weeks. It's really been starting to accelerate over the last few weeks. So one of the things we're asking is this: we created an environment where we know that the demand out there is relatively strong. The need for personal transportation remains elevated, but the supply is going to be constrained for quite some time in the new market. And we know that the fact that we've had such a massive decline in new vehicle sales means that 2-3 years from now, there's going to be a real shortage of used vehicles available to buy in the used market. So it may be that this tight inventory situation is something that's going to be around for the used market for a period of time, and that may force vehicle prices to remain elevated over the near term. And what we're starting to see from auction is that things are starting to turn a little bit. So maybe we're going to start to see that show up in the average listing price, but it's not there yet. What I'm showing you here, this is what we're seeing at auction. This is the index value of a 3-year-old vehicle, a Manheim Market Report, indexed back to the first week of the year. How is its value changing week over week relative to the first week of the year? And you can see that the green, blue, and orange lines from previous years show that a vehicle can kind of float above and below its start of the year value, but then by you get to the end of the year, normal vehicle depreciation says it's going to be selling substantially less, 10% less at the end of the year than it does at the beginning of the year. Well, what you can see in purple is that 2020 has really just blown the old trends out of the water. And we can see that during the depths of the pandemic, when the auctions were shut down and there was real concern that there was just an overabundance of used vehicles, that, get rid of your inventory, nobody's going to want these things. Well, we saw values really collapse. But then once the dealerships opened up and the governors allowed vehicles to be sold again, we could see that the demand for used vehicles really took off. And you can see that purple line really exploded. Now it's starting to come back down to earth a little bit, but it still remains quite elevated from where we were last year. And then looking at retention values, it's a very similar situation. This is the value of a group of vehicles, 3-year-old vehicles, how they're going to depreciate through the course of the year. They generally start the year at about 60% of their value, and they fall into the low 50s retention value by year's end. Again, you can see a very similar story happening in retention values. They really fell quite quickly during the worst of the pandemic. Then they've exploded really just well above what is normal retention values and are now starting to come back down to earth a little again, but still remain quite elevated. All of this is just making a lot of moving parts out there. It makes certainly setting residual values a real challenge as to unknown as to what they're going to be with this type of volatility. But I would suggest to you, I think that the used vehicle market is going to be in a relatively tight situation over the next couple of years. And I would suggest to you that we have to keep in mind that the record sales volume years for new vehicles happened in 2015 and 2016. And since then, vehicle sales have been in decline. And so we're going to have millions of fewer vehicles available for the used market come 2021, 2022, 2023. The ramifications from the decline in new activity already, and then, of course, when you throw in what's happened this year, it does suggest that in coming years, just the available supply of vehicles to that gently used segment, what we call the model year 0 to 4-year-old segment, that gently used, is really going to be quite constrained. And that would suggest that It's going to be a real scramble among dealers to battle to get that inventory. And certainly for those consumers out there that want to buy these vehicles, there's not going to be a lot of options in the new market anymore. So there's going to be a lot of consumers looking for these right at a time when there's not going to be a whole lot of these gently used vehicles available out there. So lastly, I just want to finish up by talking a little bit about the election and what the implications may be for the automotive industry as we look forward to 2021. Really, a lot of policy changes are very likely to happen if the Biden administration goes forward with a lot of the things that they talked about. But certainly one of the things that seems quite likely, regardless of who's in charge, is we're going to get a second stimulus. There's already a lot of folks complaining that we should have had this in Q4, but it seems very likely that any kind of stimulus between Nancy Pelosi as well as Mitch McConnell and signed by the president is not going to happen until we get to a new administration. So we're looking at January, likely February, that there'll be another stimulus. That's probably going to inject, we've got billion on here, it should be trillion, but we're probably looking at somewhere in the neighborhood of $1 to $1.5 trillion. But really, a lot of this is going to be support payments for a lot of the workers, much like we had before, really just trying to keep people afloat until we can get past this virus. But one of the policies that I think is very likely is that we are going to have an infrastructure spending program, one that is focused, targeted at roads, bridges, connectivity for the new vehicle market. Certainly it's going to benefit. We should see a lot of interest in sort of truck purchases, that type of thing. But also, President-elect Biden has suggested he wants to put in 500,000 electric vehicle charging stations. That could be a game changer for electric vehicle adoption in this country. Certainly, there's a lot of folks with range anxiety with electric vehicles. Having this many charging stations spread around the country may be a real contributing factor to getting folks to adopt electric vehicles much more quickly than maybe most of us are assuming. Global trade, as we all know, it's been a very volatile couple of years with President Trump in terms of going after China and threatening many of our trading partners and NAFTA. It seems likely that level of animosity between our trading partners is going to be maintained. I would expect that we're going to make nice again real soon, although I would expect that people are going to Biden's going to maintain a tough stance on China. It seems little reason to back away from a lot of the work that President Trump's already done in terms of trying to change that trade relationship. Immigration, I won't go through all these, but I do think the ones that I think are most looking at, that might be most important to us, is really along the regulation front. And the Consumer Financial Protection Bureau, that was something that was passed during the Obama administration. Republicans basically abandoned that. It seems very likely that Biden's going to go aggressive into this again. One would think that they may be starting to crack down on some of the lending activities, particularly in subprime automotive, may be vulnerable. So it may be that we might start to see some regulation tightening in terms of lending that could make it a little bit more difficult to get some customers into a loan out there. So that may be one of the headwinds that we have to look at going forward. So with that, those are my comments for today. And if there's any questions out there, if you have anything that you'd like me to cover for next time, please just send me a note. I'd be happy to get back to you, and I'd be happy to include anything that you guys might want to see in another presentation.
Charlie, thanks for joining us today. We love having you on, and as we get closer to Thanksgiving and think about what we're grateful for, I just want to take a second to thank you for coming back each month to keep us updated throughout all these moments of uncertainty that we've experienced this year. We just really appreciate you, and we value your input. So thank you again. To those on the line, join us back here on Tuesday, December 8th, as AIADA's newest affinity partner, Strategic Source, presents Maximizing 2021 Profit Through Expense Control Planning. For more information about AIADA, visit aiada.org. Thanks for joining us, everyone, and have a great day.